Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong life for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well. Hello and good morning, everyone. Welcome along. Good to see you. Kevin's here already, which is awesome. Kevin, good morning, mate. Good evening to you. Good morning to me and the rest of the crew here in Oz. All the way from Florida. Good to see you, mate. Alison is there too. Alison, how are you? Beck. Alex. Raining in Cairns. It's been absolutely bucketing down here in the Gold Coast as well. Rained all night. I'm surprised my internet's still working. Usually when it rains, the cable tunnels fill up with water and the internet poops itself. But anyway, there you go. Good to see you, Alex. Welcome along, folks. While things are getting warmed up and people are jumping on the live, do the old intros as we do. Most of you know this. Jason Whitton's my name. So that's good. If you don't know that, now you do. Welcome along if you're new. If this is your first, or maybe you found us, you've joined our coaching mentoring program, whatever it is, you're in one of our Facebook groups. Fabulous to have you here. Thanks for joining, and welcome along. Hey, each morning we get together, 10 past 8, we talk about the idea of property investing and going the distance, building a property portfolio and making sure we can last. We can go get to the destination. That's what we do. We try and sort out a bit of the fear from the fact. And for the last 2 weeks, we've been diving into the theory, the concept, the strategies, the tactics of property investing. And we've probably got another one or two Wealth Coffee Chats to roll, and then we'll probably change gears and get into what's going in the market. But that's what we're up to today, folks. Good to have you here. If you are new, or if you're feeling interactive, chuck a message in the chat. Say a quick hello, give us a shout out, and get a little active. Always good to get a little bit of feedback. Fantastic. Let's rock and roll this morning. What have we been up to in the last few days? Most of you have been on in the mornings to have a little look at this one, folks. And we've been talking about the four quadrants of, put that up there. Nah, it doesn't look any good. The 4 quadrants when it comes to property investing, or any investing, I think, in what we're up to. And what do we need to do with these 4 quadrants and these things? Your income, your assets. We've done that over the last 2 days. If you missed those 2, go back to the last 2 days and have a look at income and assets. Not all income is created equal. Not all assets are created equal, and which one and which sequence and what's better for what time and whose strategy. So we've looked at those. But today, ladies and gents, I want to look below the line. So the last couple of days, we've talked about how do we increase our income and assets, because that, folks, is the point. We want those to go up. But what we're going to do today and on Monday is we're going to look at these ones, taxes and debts, and how do we reduce them or manage them or make them effective for you and I when it comes to the world of property investing and earning income and having capital gains, and how do we manage our taxes effectively. So we're going to dive into taxes today, and it's kind of like what I call it. I wouldn't call it my favorite. But it's the one we can have the most impact on, medium to long term, folks, and long term for sure. Chris, morning to you, mate. Luke, how are you? Good to see you. It's the one we can have the most positive impact, or have the most negative impact on our investing if we don't get this right. If we don't get it right, folks, as we go. So what are the 4 taxes? What are the 4 taxes that we are exposed to as property investors? Chuck it in the chat. Chuck it in the chat, folks, and let me know. Yeah, unemployment's up a little. Inflation's down a little, Jeff. There's a lot of talk about interest rates going down sometime this year, which is great news. We won't see them go up this year, which is even better news. Yeah, fantastic. All right, tell me, folks, in the chat, most of you know this, what taxes do we have to manage as property investors, and how can we manage them, right? How can we manage them? Morning, Aaron. Good to see you, mate. Beautiful. And yep, you're on it, Beck. You've got a few there. PAYG, stamp duty, capital gains tax for sure. What's the one? Oh, there we go. Chris has got it. There's one that was missing. Right. So, number one, your income tax. Can we manage that? Yes, we can. Number two, capital gains tax. Can we manage that? Yes, we can. Number three, land tax. Bastards, you know. And then number four, stamp duty, which is technically, they don't call it a tax, but it's a damn tax, isn't it? Like, let's just call a spade, you lot. Damn, you know, the politicians call it by another name, and then the uneducated masses won't know. Yeah, you know, stuff you lot. All right, let's so income tax, capital gains tax, land tax, and stamp duty. Let's look at this. Let's break them down each one at a time. All right. Let's have a quick look at income tax as we go. All right, check out these numbers. Anyone know what these numbers are? I'm going to put these up the top. This is 120K. I worked this out before. 150K, and then 180K. And if you were PAYG, listen, it doesn't even matter if you're PAYG. At the end of the day, it matters not whether it's PAYG. If this is the declared income either via a business owner or PAYG. If you declared or earned 120 grand between you and a partner, it can be an individual or a partner, 150 or 180, right? Tell me, what would the taxes be over a 40-year working life, folks? Anyone want to have a guess? Just have a rough guess. Chuck it in the chat for me if you want to know. So you go to work for 40 years of your life, and on average, you know, you might start out at 50 grand and you might average out at 120 over your life, you know, 150, 180. Put it in the chat. Just have a little guess. Put some numbers in there, because I think for many of us, we need to realize and understand this is just income tax, by the way, right? Right? This is not, you know, rates on your property. Yeah, check this out, right? This one, this one here, $2.4 million. 2.4 million in income tax. Folks, are you kidding me? Right? But you know what? Here's an idea. You know, Luke, Chris, Beck, you know, Aaron, you know, work harder, folks. Get a promotion. Do better in your life so we can tax you more, right? And then we can jam you 3.5 million bucks. 3.5 million. And over here, $4.2 million. Right? That's the income tax, folks. Out of your pocket, that goes to the government. Now, I don't know about you. Tell me, Luke, Chris, Beck, Aaron, whoever's on the call, after you donate $4.2 million to the government, what do you get as a pension? Right. As a ratio of this donation, you've donated $4.2 million. What do you get? And that's just the start, by the way. That's not the damn, yeah, it's ludicrous. You're dead right, Aaron. You're dead right, mate. It's absolutely insanely ludicrous, right? And, you know, yeah, I love that, Chris. Yeah, 4/5 of FA, right? That's a technical term, and you're dead right. Fritz, how are you, mate? Good to see you. Fritz, Kang was reaching out to you, so keep an eye out for a message from Kang. So, you know, if we put it in terms of, you know, some of you have seen this before: Monday, Tuesday, Wednesday. You know, Monday, Tuesday, Wednesday, Thursday, Friday. You know, and who gets their part of your life, right? The ATO gets Monday and Tuesday. You know, the super company. You know, if you don't have a plan for your super, then you're making someone else rich. You know, the bank is getting Wednesday and Thursday. Then probably if you've got a credit card, the bank gets another piece of the action. And then hopefully you can live off of, Friday. That's Friday, by the way. It's not a T, it's a Friday. So that's how most people's lives work. Move to Singapore. And David, it's not a bad. Now, there's actually some conversations around that at some point when you're, and this is quite sad for Australia, when your wealth gets to a certain point, it's actually more beneficial for you and your wealth to leave the country. How ludicrous is a system that says when you get successful, we're going to tax you that much that you should move. You should take your wealth away and spend it elsewhere, not in the country you made it. It's fucking ludicrous. Like it's anyway. I won't get on my high horse today because I've got some other stuff to talk to you guys about. But here's the drill, folks. Here's the drill. You know, you've got this amount of money. If you earn 120, 150, 180, 2.4 million in taxes, 3.5 million, 4.2 million in income taxes that you would pay over a 40-year period, right? It's ludicrous. Then you come to your week, and this is what's going on with your week. How do we manage that as a property investor? Well, here's what I know, and here's why. Here's why I like new property in Australia for property investors, because if you are on $120,000, 120K, right, and you have if you have 5 new properties, so if you have 5 new properties, guess how much of this tax, at least over a 10-year period, you can get back? A 10-year period. And then what do you do every 10 years, folks? What do you do every 10 years? You buy another 5 new properties. And then the third 10 years, you buy another 5 new properties. And then the fourth 10 years, you buy another 5 new properties. How many properties do you own over 20 years or 30 years or 40 years? Well, you know the drill. Listen, if you have 5 new properties, you can get back in taxes. This would be around about $30,000 in tax. That's how much you would pay, right? You would get back 20 to 25,000. Listen to me, 20 to 25,000 back in your pocket for cash flow. And this tax here, if you followed the strategy that we showed you, the ultimate tax you would pay might be about 500, and you would get 2 million over 40 years back in your pocket. And that's why I say don't sell, because if you sell, you have to add back the tax and then you have to pay capital gains on it, but don't get too caught up in that. This is the difference. Use the tax that you would donate to the government. You're going to do it anyway, and buy yourself a property portfolio that saves you $2 million and makes you wealthy in the future. Tell me, if you did that, if you followed that plan, how much? We might get Chris to do a technical analysis. Chris, instead of 4/5 of FA, as what we would get from the government after donating $2.5 million, how much would we be able to create out of our own contribution to our own wealth into the future using the rules and the system we have right now? Maybe Chris could put that in the chat as a technical analysis for us as we go. So, folks, here's the drill. Most of us think we need more cash flow, and yeah, probably, you know, it wouldn't hurt. But I can tell you, you're donating money or giving it away and you're not using it as we go. Yeah. Yeah, David, they've been tinkering for 40 years, brother. Listen, here's what I believe about negative gearing. Use it while it's here. If it changes, that would be awesome, David, because it'll actually, as a property investor, make the rents go to where they should be, which should be about 7 to 9% rental yield. That's where they should be, right? That's where they should be. Unfortunately, that'll absolutely poleaxe all of the renters, and Labor are a bunch of tossers, right? Like, let's just face it. Anyway, but I don't really care about negative gearing or positive gearing or whatever. I'm using whatever I can to get the outcome at the moment. And if something changes, then you can't control it. You know what I mean? But they always do, David. You know, that's why new properties right now are the most tax effective, because they've literally changed the ability for you to depreciate a second owned property. And the chattels, all the furniture, all the stuff inside the building, it's actually zero now. I don't know if you guys know that. Maybe I'll do a live on that one. So they changed those rules, David, pretty significantly in 2018. You know, here's what I believe. They should, like, and this is actually better for everyone. They should get rid of negative gearing, because the rents will have to go up, and then everyone can just cover the cost of the property from the damn rent, right? For capital gains tax, I think they should get rid of capital gains tax too, because that'll encourage people to sell and not hold properties long term as we go. So yeah, interesting times. Depends on who you are, David. For PAYG, a trust is a terrible idea. For a business owner, yeah, great idea. But again, that's for another day. So, all right, we can manage our PAYG or income tax. What other taxes do we have to manage, folks? You know, these ones, capital gains tax. You know, this is with depreciation. How can we manage our capital gains tax? Well, there's a few ways, right? Make sure you own a property for more than 12 months. If you own it in your own name or you own it in a trust, you'll get a 50% discount. 50% discount on the amount that you pay on capital gains tax. I'm a big fan of never selling, so you don't have to worry about capital gains tax, folks. But there's heaps of little opportunities in here. Yeah, that's right, Chris. They're friggin' liars. They said they were going to get rid of stamp duty when they brought in GST, and now, yeah. Anyway, get me started on this. So, capital gains tax, folks. Capital gains tax. 12 months, if you own it, you get a 50% reduction in the amount you pay, or the calculation. Your own home, your place of residence, is capital gains tax free. That's why I'm a big fan of everyone owning a principal place of residence and upgrading it a couple of times. Yep, Luke, absolutely. Salary sacrifice into super is a great way to manage income tax for sure. Because on the way in, it's only 15%, right? So you can put money into your super at 15%, and then in the future, when you retire, it's a possibility of having zero income tax and zero capital gains tax in your super. So 0 for principal place of residence, 0 in your super at the age of, well, actually when you retire, could be 60, 65, depending on. 0 income tax in the future if you have money in your super and it generates an income. So that's pretty good, right? Where else? What else can be capital gains tax free? Business owners, you can own a commercial property that you run your business from, and if you tick a couple of boxes, you know, you've got to be 15 years in business and you have to have used the property for 7 years, and there's a couple of other things. But folks, listen to this. You can have a commercial property and you can sell it in the future, capital gains tax free. You can have a home. You can have property in your super, and you can own a commercial property and pay no taxes, capital gains taxes, that one, right? Okay, that's what, and if you want to know more about this, talk to your coach and your financial planner and your accountant as you go. Land tax. Folks, land tax, we've talked about this one before. I probably should split these up and do a bit of a deep dive, actually. But different states, folks, different states. At least 3 states, up to 5 different states or territories where you own real estate, okay? Why? Because each state and territory has a land tax threshold. And if you own 5 properties, let's say in Queensland, if they double in value in 15 or 20 years, you'll be paying between 20 and 30 grand of land tax. But if you owned 1 in Melbourne and you owned 1 in Canberra and you owned 1 in Sydney and you owned 1 in Brisbane and you owned 1 in Perth, let's just say 5 across those different places, and they double in value, your land tax might still be even 0, especially if you own an apartment. This is what a lot of people go, oh, apartments aren't any good. Well, you don't know what you're talking about. You have no idea. A shit property is a shit property, whether it's an apartment, a townhouse, or a house, right? However, in the future, if I buy an apartment, which I just did, a really nice one, $1.2 million, and I buy a house for $1.2 million. Both of them grow in value. They'll double in value. My apartment will, like every day of the week. They're worth $2.5 million. Now, cash flow, because that's what I want in the future, okay? That's what I want in the future. My land tax on my house, actually, I've got this going on right now. My land tax on my house is going to be about $12,000. My land tax on my apartment will be about $1,500, okay? So this is the thing. Yeah, and different entities, you're dead right, Chris. In your personal name, so you buy one and your partner buys one, and in your SMSF, a few of the states tried to jam you. The Queenslanders said, oh, listen, we're gonna make all the other properties everywhere else count for your land tax threshold when you come to Australia or come to Queensland. And then what did the other politicians in New South Wales and Victoria say? Piss off. We're not telling you anything about our land tax calculations in New South Wales. So yeah, grotty politicians always looking to change the rules and jam the voters, pricks. Anyway, and stamp duty, folks. How can you minimize stamp duty? They're, different states. When you buy in different states and territories, all of the stamp duty calculations are different. Did you guys know that? Okay. So when you go and calculate the stamp duty, if you bought the same property in all 7 places you can buy them in Australia, the difference in stamp duty ranges in $10,000, 10 grand, right? So different states, different stamp duty, and absolutely, Beck, one of the ones that we love is you can buy a house and land. So you only pay stamp duty on the land, right? And you build the house and add the value, right? You pay 50% less or maybe even 70% less stamp duty than you would normally. I love it. I love building a nice house on a good bit of land. You end up with a brand new property in a great area. I literally got my valuation back the other day on one I just built up in Wynnum. It cost me about $780 to do the pack. It took a little bit longer than I wanted, but that's construction at the moment. My valuation came back at 1.2. Very happy. Brand new property, house and land, fantastic depreciation, awesome rent. And imagine if I paid $1.2 million for a secondhand property right now, I'd get no depreciation on the internals of that property, and I would pay full freight on the stamp duty, right? Just mathematically, it's better to buy a brand new property than a secondhand property, just straight off the bat, right? Maybe the future, if you want to add value or you want to renovate or you want to develop, then, maybe a secondhand property in a spot is going to work for you. But, there we go. All right. A little bit over time today, but folks, there you go. And, taxes, and I might do a follow-up one on this on Monday, actually. and I might talk about structures, because how you own stuff is important too, right? And if you're PAYG, if you have a job and you're a career-driven person, then 99% certainty, but speak to your accountant and your financial planner about structures, companies, and trusts. But owning property in your own name is going to be perfectly fine, okay? Especially if you've got a plan into the future. Now, if you're a business owner, company and trusts are really, really powerful. And let's face it, folks, a super fund is actually a company trust structure. So if you do have a self-managed, then that might be useful too. All right. That's it from today, folks. Yeah, Alison, maintenance on a second-hand property can be quite a lot more than you want it to be, especially in the first 5 to 10 years. You want your property to give you maximum cash flow and the least amount of costs. Like, that's really the drill, right? So thanks, David. Appreciate you being here as well. Big shout out, Luke, Chris, Beck, Fritz, whoever's on the call still. Thanks for joining us. That's it for today, folks. Good to have you hanging out with me. It is Friday, so we'll do it again on Monday. Just remember that. Join me at 8:10 and we'll do it again. And I think that's it for today. Cheers, Facebook user, whoever you are. Great to have you here, folks. Thanks for joining. Be well. Have a great weekend and see you next week. Bye, folks.